Hello, welcome to my channel. Have you contributed to your registered retirement savings plan for the 2020 taxation year? The contribution deadline is March 1st, 2021. If you use your contributions effectively, you can get significant tax savings. Your tax refund is money that you can use for additional investment, education, or any other purposes. In this video, I will explain what is a RRSP, the benefits for investing in one, and how to use your contributions effectively in order to maximize your tax savings.
Registered Retirement Savings Plan is a type of financial account for holding savings and investments. Contributions can be used to reduce your taxable income and income taxes. Any income you earn in the plan is exempt from taxes as long as the money remains in the plan. Since you don't have to pay taxes on the investment income, your money can grow faster. Generally, when you take money out of your plan, you will have to pay taxes. The exceptions are the home buyer's plan and the lifelong learning plan. When you withdraw money at retirement, your marginal tax rate will likely be lower. As a result, you will pay taxes at a lower rate. You can contribute to your registered retirement savings plan as long as you have available deduction room and you are under 71 years of age. The tax savings that you get from your contributions depend on the income tax bracket you are in. Assume my taxable income was $90,000. My federal marginal tax rate is 20.5%, and my Alberta marginal tax rate is 10%. If I made a $10,000 contribution to my registered retirement savings plan, my tax savings would be $10,000 times 30.5%, which is the sum of my federal and provincial tax rate. By making the contribution, I can reduce my income taxes by $3,050. The government sets a limit on the contribution to avoid excess contributions. The deduction limit is the amount that you can contribute to your plan and or your spouse or common law partner's plan. I've included the formula here for anyone who may be interested to see it. Your earned income is the primary factor that determines your deduction limit. The deduction limit is calculated as follows. You take your unused deduction room at the end of the previous year, plus the lesser of 18% of your earned income in the previous year and the annual RRSP limit, minus pension adjustments, plus pension adjustments reversal, minus net past service pension adjustment. Luckily, you don't have to calculate this manually. You just need to enter all the information from your tax slips into the tax return software. The software will automatically calculate the contribution room for you. You can also find this number on your notice of assessment or the notice of reassessment or your T1028 statement. Alternatively, you can log into your CRA My Account, or you can call the CRA to get this information. So, what happens if you contribute to your registered retirement savings plan for more than your deduction limit? Generally, you have to pay a tax of 1% per month on any excess contributions that exceed your deduction limit by more than $2,000, unless you withdraw the excess amount or contributed to a qualifying group plan. You can set up a registered retirement savings plan through a financial institution, such as a bank, credit union, or insurance company. Your financial institution will advise you on the types of investments they can offer, such as cash, saving accounts, guaranteed investment certificates, mutual funds, and stocks. These are just some examples. You should talk to your financial institution to see what they offer. You may want to set up a self-directed plan if you prefer to build and manage your own investments. If you are considering this type of investment, you can talk to your financial institution. Personally, I have a registered retirement savings plan that is managed by a financial institution. I also have an investment account in which I make my own investment decisions. The choice would depend on your investment preference and your knowledge and experience with investing. If your income is significantly higher than your spouse or common law partner, you may want to set up a spousal registered retirement savings plan. This type of plan can help ensure that retirement income is more evenly split between you and your spouse or common law partner. It allows you to contribute money to your spouse or common law partner's plan up to your own personal contribution limit. You will still receive a tax deduction. The benefit is income splitting. If you earn more than your spouse or common law partner, contributing to a spousal registered retirement savings plan may help reduce the total amount of taxes that you pay. On the other hand, the lower income spouse will be taxed at a lower marginal tax rate when the money is withdrawn from the plan. This means potentially paying less income taxes on your investment at retirement. In terms of how to maximize your tax savings, the most important consideration is your marginal tax rate. Personally, I always contribute to my registered retirement savings plan every year to take advantage of the tax deferral on investment income. If you put your money in a non-registered savings account that earns interest, for example, you get a T5 tax slip every year, and you have to report the interest and pay income taxes. If you put it in a registered retirement savings plan, you don't have to pay taxes on investment income as long as the money remains in the plan. That way, your money can grow faster. If you expect your income to be higher in future years, you can contribute to your registered retirement savings plan and not use the deduction in the current year. You can save the deduction for future years for when your income will be higher. In order to get higher tax savings at a higher marginal tax rate, I will show you how I did this in 2018. So in 2018, I was working part-time as I was doing my MBA at the same time. My income was lower and I was in a lower tax bracket compared to 2019. I still contributed to my registered retirement savings plan in 2018 so that I didn't have to pay taxes on my investment income. However, instead of using all my deduction in 2018, I saved a portion of my deduction to 2019 when my marginal tax rate was higher. By doing that, I got a higher refund compared to what I would have gotten had I used up all my deduction in 2018. If you use a tax software to prepare your tax return, you can just put in the amount of deduction you would like to use in the current year. Any unused deduction will be carried forward to future years. If you haven't contributed to your registered retirement savings plan in 2020, you still have time. You have 60 days after the end of the year to make your registered retirement savings plan contribution for the previous year. For the 2020 tax year, the contribution deadline is March 1st, 2021. Some of you may be wondering about the difference between a registered retirement savings plan and a tax-free savings account. I will talk about TFSA in my future video. Please subscribe to my channel. Thank you. Finally, please note that the government can change the tax rules and regulations at any time. In the event of any discrepancies between this video and the Canada Revenue Agency website or documentation, please follow the information on the CRA website or documentation. Thank you so much for watching this video.